Good morning and welcome to our presentation of the Santos 2023 full year results. I'd like to start by acknowledging the traditional lands of the Gallagher people of the Adelaide Plains, where I am speaking from today. I pay my respects to their elders past, present and emerging. I'd also like to acknowledge and recognise the support of traditional owners and Indigenous people everywhere that Santos operates, including in Papua New Guinea, Timor-Leste and Alaska. I will provide an overview of the full year financial results for 2023 before handing over to Chief Financial Officer Anthea McKinnell to discuss them in more detail. Before we start, I draw your attention to the usual disclaimer. Our disciplined operating model continues to generate robust cash flows and record shareholder returns despite a challenging operating environment. Sales revenue of nearly $6 billion for the year generated EBITDAX of $4.1 billion, free cash flow from operations of $2.1 billion, and underlying profit of $1.4 billion. The board has resolved to pay a final dividend of 17.5 US cents per share, unfranked, bringing total dividends declared for the year to 26.2 US cents per share. Since 2016, our diversified portfolio of long-life, low-cost assets has delivered $11 billion in free cash flow, as shown on the chart. Strong cash flow enables Santos to undertake disciplined investment in sustaining and growing our business, whilst continuing to return cash to shareholders. The total announced shareholder returns for 2023 are a record $852 million in cash returns. At year end, our 2P reserves were 1.66 billion barrels of oil equivalent, with a reserve life ratio of 18 years. Our proved plus probable reserves replacement ratio has been 354% over the 3-year period. Santos has also added 40 million tonnes of CO2 storage resources in the Cooper Basin. The total 2P and 2C CO2 storage resources in the Cooper Basin are now at 140 million tonnes, underpinning the Moomba CCS project. Our lost time injury rate has improved substantially since 2017. However, contractor safety performance has emerged as a key watch area, and we continue to work with our contractors to drive injury rates down. Process safety performance is critical to our business. While our loss of containment incidence rate and hydrocarbon release rate are better than IOGP benchmarks, we are focused on learning from every incident and continuing to improve process safety performance across our portfolio. Always safe is a core value at Santos. Our expectation is that every day, everyone who works at Santos is focused on keeping themselves and their workmates safe and going home healthy. At GLNG, the work we have done at Fairview on horizontal drilling is expected to deliver well productivity 15 times higher than vertical wells have historically produced. GLNG also achieved a record 455 new well connections in 2023. In PNG, Angore continues to progress, and one of the 2 wells has been successfully drilled. We continue to drive productivity and reliability in our operated PNG business, with the reliability post-Oil Search merger increasing significantly to more than 95%. In the Cooper Basin, we drilled 108 wells and connected 96 in 2023, and we will continue to chase higher production this year. In the Northern Territory, we shipped 7 Darwin LNG cargoes from Bayu-Undan over the year. Bayu-Undan produced beyond expectation and continues to supply domestic gas into the Northern Territory. Life extension work at the Darwin LNG plant is underway, ahead of Barossa first gas next year. And in Western Australia, we extended the field life of Reindeer into the first half of 2024. In Alaska, the Pikka project is progressing and on track. 5 wells have been drilled, and flowback results from the first 2 wells are in line with pre-drill expectations. Our Santos Energy Solutions business continues to expand its project pipeline and is delivering on a suite of projects. The Moomba CCS project is now more than 80% complete. We have drilled 4 injection wells and we expect to begin injecting carbon dioxide later this year. Moomba CCS is a low-cost, large-scale decarbonisation project. The project has capacity to store up to 1.7 million tonnes of CO2 per year, equivalent to around 28% of the total annual emissions reduction achieved in Australia's electricity sector last year. This is an exciting milestone for our Santos Energy Solutions business, and we are progressing a potential Phase 2 Moomba CCS project, having signed 2 MOUs with potential customers. FEED for the Bayu-Undan CCS project is now more than 86% complete. We have signed 4 MOUs with potential customers, and the Australian government has passed legislation to enable cross-border carbon transfer. In Western Australia, we expect Reindeer CCS to be a customer-led project, and I am pleased to announce we have moved into FEED. We have MOUs with 4 Pilbara industrial emitters, including existing gas clients such as CITIC Pacific. And finally, I am very excited about our carbon solutions business, which continues to progress projects in Australia, PNG, and Alaska, where we are executing agreements with Alaskan landowners to generate nature-based carbon credits for our Pikka project. A number of other nature-based opportunities to generate carbon credits are in the pipeline. And these initiatives are a great example of the progress Santos is making in decarbonising, whilst developing an opportunity to create long-term value for our shareholders through the Santos Energy Solutions business. The Barossa gas project is on track following legal challenges to drilling and pipeline regulatory approvals. Since drilling recommenced in January, we have completed 1 well ahead of plan, and the second well is now in progress. Well flow results are in line with pre-drill expectations, and CO2 content is at the lower end of the concentration range of expectations. The gas export pipeline is now 68% complete, with more than half the pipe length now laid. The FPSO work in Singapore is on track, with 10 of 16 modules now installed. We are making good progress with Barossa, and first gas is now only about 18 months away. With first gas from Barossa expected next year, I wanted to take a moment to highlight the strategic importance of LNG in the energy transition and what Santos is doing to expand its LNG production to meet LNG demand in our region. Gas will remain a critical fuel for Asia over the decades ahead to enable the transition to lower carbon energy and to support both advanced and emerging Asian economies. Energy transition and the importance of energy security will continue to drive demand in Asia for LNG produced in Australia and in PNG. Santos has a portfolio of world-class LNG assets and development projects that by 2028 is expected to produce over 7 million tonnes per annum of LNG for delivery into the Asian markets. This is complemented by a quality customer base and strong contract pricing. Barossa will add around 1.8 million tonnes per annum to existing production of LNG from PNG LNG and Gladstone LNG. The Papua LNG project is expected to produce 1 million tonnes per annum of LNG by around 2028. Barossa and Papua LNG are world-class developments that will expand our low-cost LNG portfolio, which is uniquely positioned to serve the growing Asian LNG market. The proximity of our LNG portfolio to Asia provides a clear transport advantage over LNG supply from Qatar and North America. Santos is committed to reducing carbon emissions and supplying affordable, reliable, and lower carbon energy to meet demand in the Australian, domestic, and Asian LNG markets. That is why we have established Santos Energy Solutions to focus on developing projects to generate carbon credits and new revenue streams from decarbonisation projects. From the chart, you can see we have clear line of sight through CCS and nature-based projects to almost 2.5 million tonnes per annum of carbon credits by 2030, with upside in excess of 3.5 million tonnes per annum. Our strategic focus is to deliver long-term shareholder value through backfilling and sustaining our infrastructure, decarbonising our assets, and developing low-carbon fuel opportunities. That is why we're getting on with developing the Barossa gas project to deliver first gas next year, and the Pikka project in Alaska to deliver first oil in 2026. We are progressing the Moomba, Bayu-Undan and Reindeer CCS projects to decarbonise our own operations and those of our customers. These projects are funded through the strong free cash flow generated from our base business and an investment-grade balance sheet. We will continue to evaluate strategic opportunities that have the potential to unlock or create shareholder value. Along with our advisors, we've been doing this since 2016. The 3 major transactions we have completed have resulted in an upgraded portfolio, deleveraged our balance sheet, lowered production costs, including through synergies, increased operating cash flow, and increased returns to shareholders. We always welcome shareholder feedback on our strategy and on options to accelerate value. However, we will stay focused on evaluating and reviewing strategic opportunities and corporate proposals on a confidential basis, and will update shareholders when it is appropriate to do so. In the meantime, we remain focused on executing our strategy to deliver long-term value for shareholders through backfilling and sustaining our production, decarbonising operations, and developing low-carbon fuels as customer demand evolves. Santos is in good shape. The business is performing well. We have deep expertise and a very strong management team, and our focus is on delivering what we say we will do. You can see how our strategy has performed by looking at free cash flow generation since 2015. By 2026, our free cash flow target is approximately $3.5 billion. By 2028, our free cash flow target is more than $5 billion. That's more than double what we have delivered in 2023. Our diversified and strongly cash-generative portfolio will continue to drive shareholder returns through the cycle. We are decarbonising our own operations to achieve net zero Scope 1 and 2 emissions by 2040, and we are embracing the opportunity to become a low-carbon fuels company as market demand evolves. In summary, it was an exciting and challenging year for Santos. The business is strong and benefiting from a diverse portfolio of high-quality assets, and we have clear line of sight to new production volumes and cash flow from Barossa and Pikka in 2025 and 2026, respectively. We are also excited by the progress that is being made on decarbonisation and the development of new earning streams. I'll now hand over to Anthea to provide a detailed review of our financial results.
Thanks, Kevin, and hello to everyone. Santos has delivered another strong set of financial results. We continue to see the benefit of our diversified portfolio and our disciplined operating model flow through into our financial outcomes. Underlying profit for the year was $1.4 billion and our EBITDAX was $4.1 billion. We continue to generate strong cash flows with free cash flow from operations for 2023 of $2.1 billion. These strong cash flows have enabled the declaration of a final dividend in accordance with our policy of paying at least 40% of free cash flows from operations annually. The full-year dividend is a record US$17.5 cents unfranked, bringing total dividends for the year to a record 26.2 cents per share. The share buyback will remain on pause for the year. Our balance sheet remains strong with gearing at year-end of 21.8% or 18.4% when you exclude the impact of leases. The partial sell down of a 2.6% interest in PNG LNG to Kumul at the end of January has reduced gearing by a further approximately 1.8% post-year end. Santos has a disciplined operating model which aims to deliver strong cash flow from operations through the commodity price cycle. Consistent with this operating model, we target a free cash flow break-even oil price of less than $35 a barrel across the portfolio. This model ensures we can continue to sustain our production and undertake restoration activities even during periods of low commodity prices. The free cash flow from operations generated above sustaining capital requirements is available to be deployed to deliver returns to shareholders, maintain a strong balance sheet by debt reduction, and invest in major projects, including our decarbonization projects. We continue to maintain a strong focus on costs across our operational business. Production costs of $782 million are lower year on year, predominantly due to lower throughput at Darwin LNG and lower costs in PNG. Our unit production costs have remained competitive at $7.61, excluding Bayu-Undan, and this reflects the discipline across our producing assets, which have largely absorbed inflationary pressures. For 2024, we're guiding production costs, excluding Bayu-Undan, of between $7.45 and $7.95 per barrel. And as noted on the previous slide, our disciplined operating model targets a free cash flow break-even cost of less than $35 per barrel. For 2023, we achieved a cash flow break-even of less than $28 per barrel and less than $22 per barrel on a hedged basis. For 2024, we are targeting less than $35 per barrel unhedged. We are guiding a free cash flow sensitivity for 2024 of $400 million in free cash flow for every $10 increase in Brent pricing. 2024 is expected to be a peak capex year for the company, predominantly related to our major capital projects Barossa and Pikka, and feed costs for the Papua LNG project in PNG. In 2025, capex drops materially. We're guiding major capital spend of approximately $1.6 billion for 2024. Sustaining capital, which includes capital to sustain our production as well as restoration costs, is expected to be around $1.25 billion, up slightly from the prior year, and includes approximately $300 million in decommissioning costs. With Barossa targeted to come online in around 18 months' time, our capital burden will decrease quite quickly after 2024, releasing balance sheet capacity for capital to be allocated in accordance with our capital allocation framework. Our diversified portfolio of upstream gas and liquids assets, together with strong LNG contracts and fixed-price domestic gas contracts, underpins an operating cash flow of $3.3 billion. The reduction in cash flow from prior year has been driven primarily by a 30% reduction in the average realised oil price compared to the prior year, a 17% reduction in the realised LNG price, and a 12% reduction in production volumes year on year. We have delivered strong free cash flow from operations of $2.1 billion. Product sales revenue, whilst down from the high prices we saw last year, is strong at almost $6 billion. EBITDAX of $4 billion translated into underlying earnings of over $1.4 billion. This table shows a snapshot of the full year results, outlining the strength across each of our businesses and the contributions to EBITDAX and margins. It highlights our diversified and balanced portfolio of core assets, with strong margins of 68% for the year across the portfolio. We are focused on maintaining a strong balance sheet to ensure we are positioned to deliver on our strategy. As mentioned earlier, gearing was within our target range. We continue to target a strong level of liquidity and held liquidity of $4.5 billion at year end in a combination of cash and undrawn finance facilities. We continue to have strong interest in our business from debt capital markets, and this was reflected in the strong demand for our recent debt issuance, in the Reg S 145 market, where we issued a 10-year $850 million bond. We also placed oil hedges in 2023 for delivery across 2024 using a zero-cost collar structure. We have 18 million barrels hedged at a floor of between $75 and $80 and a cap of between $90 and $91. This provides downside protection to commodity prices in this capital-intensive year. We continue to focus on access to capital from a diversity of sources and markets. We have a supportive banking group with over $3 billion in bilateral and syndicated loan facilities available to us, the majority of which are undrawn and with maturities ranging from 2024 to 2028. Excluding PNG LNG, we have no drawn debt maturities until 2027. PNG LNG finance is repaid using project cash flows, with the final PNG LNG financing payment due in 2026. We maintain our current stable investment grade ratings with the 3 major rating agencies. Thank you, and I'll now hand back to Kevin.
Thank you, Anthea. In summary, 2023 was a great year with plenty of challenges. The pace of change in energy markets, technologies, and products continues to be unrelenting. Santos is a strong base business, a diverse portfolio of high-quality assets, and is designed to be resilient across a wide range of energy transition scenarios. The company continues to perform well and has a strong pipeline of upstream production and new revenue streams from decarbonization projects to deliver long-term value for shareholders. Thank you.